Hey, what's going on, traders? Welcome to today's video. In today's video, it's going to be another how-to video. We're going to be talking about margin accounts, everything that you need to know about margin accounts and what I believe are the pros and cons behind trading in a margin account. I'm going to explain to you a few different things that I think new investors need to know about if you are planning to trade using a margin account. If you enjoyed this content, guys, welcome and smash the like button. Let's get to it right now. So the first thing we want to be aware of here is, what is a margin account? Well, a margin account is a brokerage account in which the broker lends the customer cash to purchase stocks or other financial products. That is the simplest way to understand it. Now, when you're trading in a margin account, this is what happens. You can make a purchase or a sale of a stock, for example, and depending on the stock you're trading, the broker will allow you some leverage. Oftentimes for stocks, they follow something called a Reg T model, which is somewhere between a 3-to-1 and a 4-to-1 leverage. And again, it does depend from ticker to ticker. And I'm going to show you briefly how do you determine the margin requirement for whatever product you're trading using Interactive Brokers, because that's a broker that I've used for quite a while. And they also happen to have the lowest margin rates compared to the other bigger brokers in the industry. Not to say that IB is the best, because they certainly have their downfalls. However, IB is still one of the only brokers that offers worldwide access to the US equities markets. So that's why they kind of shine compared to the other brokers, and they do have low margin interest. So when the broker is loaning you that buying power, you are paying them interest on that loan. So this right here is the amount that IB will be charging you in interest on a yearly basis for the amount that they're loaning you for your trading positions. Okay, so I'm going to show you briefly how do you determine the margin requirement for a stock in IB. Well, you need to make sure first that the order confirmation window is turned on in your platform. And what I'm going to do now is just submit a random order, and you're going to see here's the order confirmation window. Now, if you don't get this, it means that you turned it off in the platform. You clicked on this right here and you turned it off. And if you do that, it's never going to appear again. And the way you turn it back on is very simple. You go to File, Global, then you go to Messages, and then you go here to confirm order submission. Make sure that this box is checked, and then you're going to get the confirm order window, and it's going to tell you what your initial margin is on the trade. So this is a trade, for example, 100 shares for Apple stock. The amount is 14.5 grand USD. That's the total value of the shares that you would be buying in this case. Now, if we go over to the right side of the screen here, this is the important information where it says initial margin. This right here is the amount that you're actually putting up in your own buying power, 6,144. The rest of the value of the trade, the broker is loaning you that money. And also, if you go down right here, it says this is a current projection and is subject to change. So now let's click on margin requirements, and you can see it appears right there as 30%, meaning that you are only required to put up 30% of the value of this trade. The broker is loaning you the other 70%. So now if you want to do a brief calculation of that, so the value of this trade is 14,568 minus our initial margin, which is 6,144. So the broker is loaning you 8,424 times 1.59% equals $133.9. So this is the amount of money you're going to be paying the broker for interest if you hold this trade for 1 year. Since the moment you bought it, 12 months after, you would have paid your broker $134 in margin interest for that 8.5 grand that they're loaning you as 70% of your trading position. Okay, so you'd be paying $11 a month in interest there. And it will depend from stock to stock. So make sure that you're checking to see what your initial margins are. What's really important in a margin account, this right here, you see where it says maintenance? So in this demo account, there's no positions on right now. However, if I did have some positions on, this maintenance would be a higher number than 0. Because when you have a position on in a margin account, there is a limit to how low the value of your account can go, because the broker is loaning you a percentage of the capital for the trades you're putting on. And this is for stocks. If your account net liquidity is getting too close to the maintenance, then there is a great risk that the broker is going to send you a message and saying they're going to liquidate some of your trades. So be very careful when you're trading in a margin account and your net liquidity is getting too close to the maintenance level. It basically means that the value of your positions has now dropped to a point where in order to maintain these positions, you need to deposit a little bit more capital into your account. That's called a margin call, and you do not want to experience this. That's why you're on this video learning about margin accounts. So now guys, let's talk about the pros and cons of margin accounts. In my opinion, there are a few pros and there are also a few cons. So in my opinion, the pros of a margin account, here we go. The first one is avoiding T+2 settlement. What is T+2 settlement? Well, it's basically whenever you make a trade in a cash account, for example, you need to wait 2 days for that trade to settle. And this applies to any trade. It could also be exchanging currency from US dollars to euros. Let's say you made a currency exchange in your account, you sold some USD and you bought some euros. Now you want to withdraw your euros. Well, wait a minute. In a cash account, you need to wait 2 days before you withdraw those euros. In a margin account, there is no T+2 settlement. They will allow you to submit the withdrawal right after the trade has gone through. This is only allowed in a margin account. So when you do have a margin account, you're able to bypass that T+2 settlement. Very convenient, especially if you need to move funds around quickly. The next pro of a margin account, well, logically, it's the higher leverage. The broker is allowing you more buying power. Therefore, you can capitalize on this by increasing your position size. With greater potential reward comes greater potential risk. So of course, the leverage factor of a margin account is basically why traders use margin accounts. Normally, traders who are in and out of positions very fast, having a lower capital requirement is very beneficial for them because they're not interested in holding that trade for a long period of time anyways. The leverage for them is just an upside because they're protected with their stop loss anyways. So another pro of having a margin account is the fact that you have the ability to diversify your portfolio a lot more by gaining access to more products to trade, like futures. So futures contracts were originally invented for the purpose of hedging, where farmers had to balance their inventories and they would use futures to fix prices on their inventory to protect themselves against the risk of natural disasters. So let's say our investor has a portfolio of stocks and they need a quick way to diversify their holdings, and maybe they want to buy some precious metals. Well, you can use some products, for example, small precious metals on the small exchange. The symbol is PRESME. You put it in there, get the futures contract. This contract has an initial margin. So basically the buying power you need to put up is $1,000, but the notional size of this contract is just under 7,000. You can see that futures in this case offer slightly more leverage than stocks do, and it will depend on your broker, but it is commonly known that futures offer more leverage than stocks. Again, so futures are a quick way of diversifying your portfolio in a margin account. You do need a margin account to trade futures. And again, guys, do not forget to check out all of these products here available on IB that trade on the small exchange. All right, let's talk briefly about the cons of a margin account now. Well, like I said earlier, with greater leverage comes greater risk. In the case where you are holding some positions and the value of your trades has now decreased to the point where your account value is now kind of inching its way towards your maintenance margin. And the way Interactive Brokers does this, they're not lenient with margin calls. As soon as your account value is getting close to your maintenance margin level, they start notifying you and your account basically gets flagged. And if you don't do anything about it, they're going to start liquidating your trades that are causing your account to go below your maintenance margin level. So definitely if you use a margin account, you need to be aware of this at all times. Just be aware of maxing out your buying power and having your account drop too close to your maintenance margin level. So it's like you had a revolver and you shot all your bullets and now there's 5 cowboys running right at you and you have no more bullets. That's what the market's going to do to you, and your broker's going to give you a margin call and you're going to get liquidated. So you need to know about these things, all right, guys? Now, still talking about the cons of a margin account, it really depends on the goals of the investor. Let's say, for example, our investor, he's investing in dividend stocks and he just wants to use his own capital to buy these stocks, and he does not want to be loaned money from his broker to buy and hold these stocks. In that case, the investor would prefer a cash account because in a margin account, the broker will be loaning them a portion of that buying power. So the broker will allow them to purchase more shares of that dividend stock, but at the end of the year, they're still going to be paying a portion of those dividends back to the broker in interest on the margin loan. The investor definitely needs to do their math there to see if it will be worth it for them to purchase and hold dividend stocks in a margin account. So that's one scenario I can think of where a margin account is less ideal. One last thing you do need to be aware of in a margin account with IB is that you should never, ever let any of your cash balances dip into the negative, because I believe as soon as this happens, you are getting charged a margin interest on that negative cash balance. So never hold a negative cash balance in an account. It's not a smart idea to do that. You're gonna start paying interest for nothing, basically. So that's gonna cut it for this video, guys. If you found it educational, let me know in the comments below, and I will catch you in the next one. Take care, bye.